Have you ever been there? You're staring at a chart, you spot a perfect looking hammer or maybe a big engulfing pattern, and you jump into a trade feeling super confident, only to watch the market just immediately turn against you. Ugh, it's the worst. Well, if you are sick and tired of candlestick patterns that feel like they're just not working, then you are in the right place. We're going to break down the number one reason why so many traders fail and exactly how you can avoid that trap. Okay, let's get into it. So let's just start with a really hard truth right off the bat. This isn't just someone's opinion, okay? This is a fundamental reality of the market. The reason you might be struggling isn't that the patterns are fake or a scam. It's because you've been taught to use them in the completely wrong order. And that's the most frustrating part, isn't it? You did the work. You memorized all the names, you can spot a doji from a mile away, you followed every single rule in the book. So why does it still feel like you're just flipping a coin? It's because you've probably fallen into a very common and very, very costly trap. Yeah, we're calling this the candlestick trap. It's this whole idea that just being able to identify a pattern on a chart is enough to make a solid trading decision. It is honestly the biggest myth in retail trading education, and today we're going to take it apart piece by piece. So here's the absolute key takeaway. Looking at a single candlestick by itself is like hearing one single word without the rest of the sentence. A hammer candlestick, it means absolutely nothing on its own. It only gets its power, its meaning, from where it shows up on the chart and when it shows up. Think of it like this. Candlesticks. They're like the alphabet of the market. You can't write a story just by knowing the letter A. You need structure, you need grammar, you need context. And this right here is the solution. This is the exact hierarchy that professional traders use, and you'll notice what's at the very bottom of the list. It starts with market structure first, then you identify the key levels. After that, you understand the context of what's happening, and only then, dead last, do you even bother looking at the specific candlesticks. They are the final piece of evidence, not the reason to start looking in the first place. All right, let's dig into the first and, honestly, the most important step. Market structure. This is the bedrock of everything we're going to do. Seriously, if you get this part wrong, nothing else you do is going to matter. This is it. This is the single most important question in all of trading. Before you do anything else, you have to know, is the price generally moving up? Is it generally moving down? Or is it just kind of stuck going sideways in a range? Every single decision you make from here on out flows from the answer to this one simple question. And here's the beautiful part. There's no guesswork here. It's objective. An uptrend is just a series of higher highs and higher lows. And a downtrend? It's just a series of lower lows and lower highs. That's it. All you're doing is mapping out the peaks and the valleys on your chart. This isn't a feeling or an opinion. It's a fact of what the price is actually doing. Let's just be totally blunt about this. If you place a trade without first identifying the market structure, you are not trading. You're gambling. You're betting on a single word and just hoping it makes sense in the sentence. And trust me, that is a losing game in the long run. Okay, so once we know the overall direction, the structure, now we need to identify the important locations on our map. This is step 2, finding the key levels. Think of these as the major battlegrounds where the buyers and the sellers are really going to fight it out. This is where the story happens. A candlestick pattern that appears in the middle of some random price move, in the middle of nowhere on your chart, is just noise. It's totally meaningless. The only time a candle story actually becomes important is when it happens at a place we already know is significant. We're talking about those previous turning points, the ceilings and the floors, where price has had a big reaction before. This needs to become your new mantra. Seriously, print this out, write it on a sticky note, put it on your monitor. If the price is not at a key level that you've already marked out, there's nothing to do. You just wait. Patience is what separates real traders from people who just donate their money to the market. All right, so we've got our structure, we've got our key levels. Now we can finally talk about the candles themselves. This brings us to steps 3 and 4, understanding the context and reading the candles. And look, they go hand in hand. Forget about memorizing 50 different fancy pattern names. You can throw all that out. You only need to understand 3 core ideas to read the story price is telling you. First up, rejection. You see that long wick on the candle? That's a footprint in the sand. It's evidence. It shows that price tried its best to push through a key level, but a huge wave of sellers or buyers jumped in and just slammed it right back. It's the story of a failed attempt, and that story is powerful information. Second concept, continuation. So imagine we're in a nice, clear uptrend. Price pulls back a little bit, right down to one of our key support levels. And then, Bam! You get a big, strong, solid green candle. What is that telling you? It's screaming, okay, the little rest is over. The original buyers are back in charge, and we're ready to go higher. It's a sign the uptrend is likely to continue. And third, failure. Now, this one is a little more advanced, but oh man, it is so powerful when you spot it. This is when you see a big, strong candle that looks like it's breaking through a key level, but then the very next candle just completely reverses it and closes back on the other side. This is a trap. It tells you that all the traders who chased that breakout are now trapped and losing money. And what will they have to do? They'll have to sell, which just adds more fuel to the fire for the reversal. So when you put all of this together, the structure, the levels, the context of the candles, you're finally faced with a choice. And it's a choice you have to make every single time you open up a chart. Are you going to be a professional trader, or are you going to be a gambler? Now, check this out. The gambler. They're the ones chasing random patterns, hoping for a quick buck. They ignore the big picture. But the trader, that's you, studies the structure first and then waits, with patience, for the price to come to them at a key spot. The gambler blames the market when they lose. The trader understands their job is simply to read the story of price and take responsibility. This right here, this is the whole mental shift you need to make. So how do you actually make that shift? You've got to practice. So for the next 7 days, I want you to try this super simple, completely risk-free exercise. Pick one chart, just one, and one time frame, like the 4-hour or the daily. And here's the most important rule. You are not allowed to place a single trade. Your only job is to be a detective. Mark the structure, identify your key levels, and then just watch. Ask yourself, what story did the candles tell when they finally arrived at those important places? And that leaves us with this one last question to think about. The next time you open a chart, I want you to ask yourself this. Are you patiently observing the story of the market, waiting for a clear signal at a logical location? Or are you just throwing money at shadows on the wall, gambling on an outcome? The choice, and ultimately the results, they're entirely up to you.